The Nikkei 225 just dropped over 600 points in a single session, and the headlines are screaming about a looming sell-off. But while the crowd panics, the smartest money I track is quietly loading a trade that could ride a melt-up all the way to 67,000. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm handing you 3 exact levels you can trade tomorrow, with stops and targets so precise you'll be able to place your orders before you finish your morning coffee. If you've been waiting for a high-certainty setup on the Nikkei, this is it, right here, right now. The intraday bias is bearish fading within a powerful weekly and monthly bull structure. We are in a correction, not a crash, but corrections can turn into liquidity vacuums if you don't know where the line is. The single invalidation level that flips the entire near-term view is 63,059. That's the daily S1 pivot support, and it aligns with a structural demand zone that has held every dip for the last 3 weeks. Write this number down. 63,059. If we get a daily close below that level, the bull trend on the daily timeframe resets, and we could see an accelerated unwind straight into 61,660, maybe even lower. But if 63.59 holds, this pullback is nothing more than a healthy reset before the next leg towards 67,000, the exact target the AI gold rush narrative is putting on every institutional radar. Now, here's what the herd is doing, and it matters. On the 1-hour chart, the trend is a strong sell, and retail sentiment has flipped aggressively short, chasing momentum lower. Meanwhile, ETF flows into Japanese equities have been net positive this week, and the big Japan semiconductor names are seeing quiet accumulation. That divergence, retail short, institutional bid, is exactly the kind of tinder that lights a violent short squeeze. If price reclaims the pivot at 64,668, you can expect an explosive move that punishes late shorts. Write that number too, 64,668. Above that, the trap springs long. Let's walk down the charts the way we do on the institutional desk. Start with the monthly. The Nikkei is a strong buy, riding a rising 50-month moving average near 59,500, untouched by this pullback. The 200-month sits way down at 55,249. That tells you the long-term trend is so firmly up that we would need a structural macro shock to even test it. Zoom into the weekly. Strong buy, with the 50-week moving average at 62,406, rising sharply, and the 100-week at 59,519. The 200-week is a distant memory at 55,000. Weekly momentum is still constructive, but the MACD histogram is starting to lose altitude, which is your early warning that the weekly trend is decelerating. Now the daily. This is where the battle is being fought. The daily trend is neutral, and price just cleaved through the 5-day moving average at 64,800, the 10-day at 64,973, and the 20-day at 64,654 in a single session. That is a liquidation event in short-term momentum, but it has not yet broken the structure of higher lows. The daily ADX is 32, telling you trend strength is still above threshold, but it's rolling over, so the trend is losing conviction. The commodity channel index is deeply negative at minus 104.87, signaling that we are oversold on this time frame, but oversold in a downtrend can stay oversold. The MACD line is still above its signal line, but the histogram bars are shrinking fast. That's the first divergence. Price makes a new low, but momentum is not confirming the full force of the sell-off, yet. If that histogram flips negative, the daily trend officially turns sell, and 63.59 becomes a magnet that must hold. Now drop to the 4-hour. Strong sell. Price is below all its moving averages. The 5-period MA is curling down aggressively at 64,800. The 20 is at 64,654, and the 50 sits down near 62,406, a long way away. Every bounce is being sold. But here's what most traders miss, and this is the part that separates amateurs from professionals. The 4-hour RSI is not yet at deeply oversold levels, but the 1-hour stochastic is still elevated at 93, despite the drop. That tells you there is still residual overbought energy from the prior rally being unwound. This pullback may have another flush before it finds a genuine floor. We have not seen capitulation yet. The ATR on the daily is 1,771 points. That's a gigantic range. So if we do get a support hold at 63,000, a bounce can cover 500 points in an hour, easily. The hidden divergence you need to watch is on the 1-hour MACD. Right now it's bearish, but if price makes a slightly lower low towards 63.59 and the MACD line puts in a higher low, that is your sniper trigger. That's the stealth reversal signal that the smart money will use to load up while retail is still panic selling. The pivot point, 64,668, remains the bull-bear equator. A 1-hour close above that would be the first domino toward a retest of 66,066, the R1 resistance. Reject it, and we go to 63.59 again, then 61,660. The moving average alignment on the daily, with the 50 firmly rising at 62,406, is your structural floor. As long as that holds on any closing basis, the medium-term bull trend remains alive, and we treat dips as buying opportunities. Let's stitch the fundamentals into the price action, because the narrative is what fuels the volatility. The 24-hour core news is precisely this. A Japan AI gold rush could send the Nikkei soaring to 67,000, but a sell-off may loom. That's not a vague headline. That's the exact cognitive dissonance being priced right now. On one side, the government is making massive AI infrastructure pledges, and semiconductor names are seeing earnings revisions higher. On the other side, profit-taking is accelerating ahead of a potential Bank of Japan policy tweak next week, and the yen is showing subtle strength that could squeeze exporter margins. If USD JPY loses the 150 handle, it will act as a headwind for the Nikkei. But here's the cross-linkage that matters most. The Nikkei is tracking tick for tick with the Nasdaq futures right now, not with the yen. Global risk appetite, driven by US tech earnings and bond yields, is the true puppet master. The S&P 500 E-mini breaking above its gamma flip level would drag the Nikkei through the 64,668 pivot like it's not even there. My 1 to 2 week directional lean is bullish on dips, targeting a run towards 67,000, but only if 63.59 holds on a daily close. The exact event that invalidates that lean is a weekly close below 62,406, the 50-week moving average. If that occurs, the AI narrative gets shelved, and we are trading a macro risk-off event that takes this index into the low 60s. So, the question I need you to answer, do you think the Nikkei hits 67,000 before July, or does the sell-off accelerate first? Comment 67K or pullback right now. I'm tracking consensus and I'll mention the tally in tomorrow's video. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to give you 3 precise strategies with exact numbers that you can screenshot and place immediately. Strategy 1. The sniper, conservative. This is a buy on support play designed for patience. You wait for the market to come to you. The exact trigger condition, a 4-hour bullish MACD divergence at or just above 63,100. That is a few ticks above the S1 support of 63.59, giving you a cushion. Place a buy limit order at 63,100. Your stop loss goes at 62,850, below the round number and beneath a recent swing low, giving the trade breathing room around the 63.59 floor. Target 1 is the pivot point, 64,668. That gives you a risk reward of 1 to 2.3. Target 2 is the R1 resistance, 66,066, which extends the risk reward to 1 to 5.5. That's an asymmetric setup. The setup is void if any 4-hour candle closes below 63,059. If that happens, you step aside and wait for the next demand zone. The sniper, conservative. Entry 63,100 limit. Stop 62,850. Take profit 164,668. Take profit 266,066. Risk reward 1 to 2.3/1 to 5.5. Invalidation. 4-hour close below 63,059. Screenshot that. Strategy 2. The active trader, standard. This is a mean reversion play on a failed bounce, For those who want to participate in the ongoing short-term downtrend but still respect the larger bull structure, you wait for a retest of the resistance confluence near 64,700. That's where the 5-day, 10-day, and 20-day moving averages all cluster, creating a formidable ceiling. Your entry trigger is a bearish 1-hour engulfing candle that closes below the open of the prior green candle at that zone. Place a sell stop entry at 64,700. Stop loss goes at 65,200, above the recent minor swing high and safely above the moving average resistance cluster. Target 1 is 63,500, a level that offers quick partial profits as momentum carries south. At that point, trail your stop to break even. Target 2 is the S1 support itself, 63,059. This delivers a risk reward of 1 to 2.3. Invalidation, a 4-hour. Close above 65,200 voids the short bias entirely, signaling that the bulls have reclaimed control and a breakout towards 66,000 is back on the table. The active trader, standard. Entry, short at 64,700 on 1-hour bearish engulfing. Stop loss 65,200. Take profit 163,500. Take profit 263,059. Risk reward 1 to 2.3. Invalidation, 4-hour close above 65,200. Snap that and hold it. Now I need you to do something right now. Type your Nikkei range for tomorrow in the comments. Give me a high and a low. I want to see who's aligned with the pivot levels we've just mapped. Drop those numbers below. Strategy 3, the aggressor, high risk. This is for traders who understand counter-trend momentum and can lose small without hesitation. The play is a breakdown momentum short on the 15-minute chart, targeting a rapid flush that capitalizes on intraday panic. Wait for a 15-minute close below 63,800. That's a level just under today's intraday structure and psychological whole number. Enter a sell stop at 63,800. Place a tight stop loss at 64,200, just above the breakdown zone. Target 1 is 63,059. The S1 magnet, which gives you a risk reward of 1 to 2.5 from entry. If the flush is violent, we can stretch to target 2 at 62,500, a clean swing point that would turn the risk reward to 1 to 4.8. This setup is void if the 15-minute chart closes back above 64,000 before triggering. Only take this if you can accept a quick stop out and are prepared to manage the position actively. The aggressor, high risk. Entry, sell stop at 63,800 on 15-minute close below. Stop loss 64,200. Take profit 163,059. Take profit 262,500. Risk reward 1 to 2.5/1 to 4.8. Invalidation, 15-minute close above 64,000. Only for aggressive risk management. Now the risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news like a Bank of Japan policy announcement or US CPI. Stops are non-negotiable. They are the oxygen mask that keeps you alive when the market turns against you. If you respect these rules, you survive to trade the next big move. If you ignore them, the Nikkei will separate you from your capital without a second thought. Let's bring it home. The single most critical level for the next session is 63,059. If that level holds on a daily closing basis, the entire bull thesis from the AI gold rush remains intact, and the path towards 67,000 is cleared. If we lose it, the structure resets and we are trading a larger correction towards 61,660 and possibly lower. Tomorrow's wildcard is the US PPI data and any fresh headlines out of the Bank of Japan. A surprise hawkish tilt from the BOJ could accelerate the sell-off, while a soft US number could ignite a risk-on melt-up that rips through the pivot and punishes anyone still short. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen and it'll take you straight there. Smash the like button if this gave you a clear plan for the Nikkei. Subscribe, hit the bell, and I will see you in the next one, before the next explosive move.